Most people believe the money in their bank account is sitting safely inside a vault, waiting for them. But that's one of the biggest financial illusions ever created. In reality, most of the money you use every day was never physically printed. It was created with a few clicks on a computer. Imagine walking into a bank and depositing $1,000. It feels like your money is simply being stored. But the bank sees something different. Instead of locking that cash away forever, it uses it to issue loans. Someone else borrows money to buy a car, start a business, or purchase a house. Suddenly, new money begins flowing through the economy. But here's where things get strange. The bank doesn't always hand over stacks of cash. In today's digital world, it simply creates a new balance in the borrower's account. That digital balance becomes real money the moment it's spent. The restaurant owner deposits it into another bank, which can then issue more loans. The cycle repeats over and over, expanding the amount of money circulating in the economy. If this sounds like money is being created out of thin air, that's because in many ways it is. Today, more than 90% of the world's money exists only as digital numbers. It isn't paper, it isn't coins. It's information stored on computers. Every tap of your card, every online payment, and every bank transfer moves invisible money across global networks in seconds. So why can't banks create unlimited money and make everyone rich? Because every loan carries risk. If borrowers stop repaying, banks begin losing money. That's why banks carefully check credit scores, income, and financial history before approving loans. Their entire business depends on one thing: trust that borrowers will pay the money back. History has shown what happens when that trust disappears. During the 2008 global financial crisis, banks issued too many risky home loans. When millions of people couldn't repay them, confidence collapsed. Banks became afraid to lend. Businesses struggled to borrow and economies around the world slowed dramatically. It wasn't just a housing crisis, it was a crisis of trust. Behind the scenes, central banks like the Federal Reserve influenced this entire system. By raising or lowering interest rates, they encourage banks to lend more or less. Lower rates usually mean more borrowing, more spending, and faster economic growth. Higher rates slow everything down to control inflation. So the next time you check your bank balance, remember something most people never realize. Those numbers aren't piles of cash waiting inside a vault. They're part of a vast network built on loans, confidence, and trust. The modern economy isn't powered by paper money. It's powered by the belief that those digital numbers will still have value tomorrow. And that may be the most powerful illusion ever created.